And we're live. Welcome back, everyone. Welcome to the third session on our Small Business Success Series. In the first session, you heard from Lisa Campbell from Profit First Professionals Canada, and she passionately spoke about building wealth for small business owners. And then in the second session, you heard from Dill from True North Accounting, who talked about his small business with his dad, as well as his foray into forming a accounting company for small business owners in Alberta. And today, and he talked to us about how to save taxes or how to save on our tax bills and how to optimize them. And today we have Cheyenne with us from SRJ Accounting, talking to us about our income strategy. So RSP contribution, TFSA, as well as how we can optimize our income as small business owners. And before we jump into it, I'm going to do my bit about how Cheyenne got into helping small business owners and himself as a small business owner. So everyone, welcome Cheyenne.
Awesome. Thanks, Amna.
Hi, Cheyenne.
Appreciate you having me here today.
Welcome. So you are a small business owner. So tell me the story of you becoming a small business owner.
For sure. So I've always enjoyed learning how people create businesses, create not-for-profit projects, charities, and I love seeing that journey. And I think the journey is where we have the most fun and we learn the most. And I love, for some reason, tax. I don't know why. When I was in grade 10, I took a tax course at like an H&R Block type of place. And I learned on my own how to do taxes, and I never stopped from there. So I've always enjoyed it. I've enjoyed seeing how people make money and how they build, and how not to pay tax or how to minimize their tax payments. And yeah, we've grown our firm. I think we started about 12 years ago, and now we're at more than 50 staff operating across Canada. And with clients in Canada and the US. It's been fun, and we're still on this journey, and we're enjoying it. And I get to work with entrepreneurs across the globe, actually, and it's fantastic to learn from them and feel their energy on a daily basis.
That is an amazing journey. So you started as a one person loving tax, as anyone would do, right, in our lifetimes.
Yeah, exactly.
And then you grew the company to 50 people. That's an amazing story. I think this calls for an applause from everyone, because growing a small business is not easy. And I know that firsthand of building Fuse Financial in the last 2 years. And you have been building SRJ for you said 12 years now, right?
Yeah, it's been a while. Yeah, and the fun part is that I got to start it with one of my best friends, who's also a CPA and a master's of taxation. So we've been able to go on this journey together, and it's hard to maintain any relationship for that long. Not only building a company at the same time. So we've been really blessed to have each other and work together to build it out.
Oh, okay, that's fantastic. Well, kudos to both of you for doing such a fantastic job in building this business. This is where you also get to plug SRJ and how you help small business owners across Canada. So tell me a little bit about SRJ and what are some of the services that you provide?
Yeah, so we focus on tax compliance. We're not doing any assurance or audit work. So we're focused on being in the trenches, with our clients. That could be from an initial setup to growth and scaling. And because we've done it ourselves, we're able to add a little bit more value than just like the tax compliance. So we're managing the accounting functions for a lot of companies as well now. Probably, we're approaching 80 or 90 companies that we're managing their full accounting functions for them. And it's a really interesting space because we're able to optimize what they're doing and have interactions with the numbers in the business on a day-to-day basis. So we can really add a lot more value that way. We're able to automate, put in the latest cloud technology. So that's why, also to plug you back, that's why I love what you're building, and I'm so inspired by what you do, and that's why I invited so many people to come today because I want them to learn about Fuse. And it's just so cool now what we can do with technology. We don't have to rely on manual tasks and manual systems. We can use all these cloud-based platforms, specifically Fuse. So people need to understand that you don't need to waste time doing things. A lot of it, there's so many amazing tools now, and what you guys have done a great job of, and why I love it, is because you put it all in one place, rather than us where in the past we had to use like 5 different software packages or 5 different cloud applications. Now, like what you guys have done is you all put it all in one place, and there's so many issues in terms of like banking in Canada and getting things connected. But you guys obviously are solving for that and making a solution that a lot of small business owners need.
Yeah, that's exactly what we're doing. We are bringing it all together. So you, as an accountant, is spending less time on, balancing and reconciling the books, and more time on actually helping being a partner of small business owners, which is what your true passion and vision is for yourself, and help them grow, and be their partner in that growth journey, be their partner in, helping them with a lot of value add knowledge and advisory, which is what you bring. And we just want to take away all of those manual things that you have to do to get there. And also in the process, save time and money for small business owners as well. So they don't have to have 6 different tools to have the same efficiency of their financial operations. So having said that, let's jump into incomes for small business owners. It's such a like, as an employee, it's very clear. You get paid, right? You get paid, there's income. But for small business owners, it's not as a clear cut, because there are different ways that they can bring that income from their business that would help them optimize every dollar, right? And make it go further than make it go further and create more wealth in the process for them. So yeah, let's dive right into why everybody has joined us today, to learn about the income splitting strategies, the TFSA, the RRSP. And I believe, like, even if you're an employee, you're going to learn something about this, because making an RSP contribution always is not the best choice, right? There's that tipping point when it becomes a better choice for you to do that. So let's dive right into it.
For sure. All right. So the way we're going to structure this is we're going to look at it from a couple of lenses, and the main focus will be from an entrepreneur, or if you're advising entrepreneurs, on how they're able to benefit from a corporation. That's the ideal scenario for anyone who is growing or scaling a business. You want to get from the position that you're starting off as a sole proprietor, and you've created some goodwill, some brand, and now you're at a position where hopefully you can retain funds in the corporation, or find ways to extract those funds in a tax efficient manner. So that's where we're going to try to focus. And if we have a Q&A, or if there are some questions afterwards, I'm not sure if we have time for that, but if we do, then we can dig into like more specific items. So I'm going to do it more general, and then I'll dive into some specific areas that I think need more explaining.
Sounds good.
All right.
And folks, if you have any questions.
Yeah. So in the presentation, we'll talk the basics of incorporation, why it makes sense. We'll go through tax savings, why the corporation allows you to save tax, and then how you should really use it to minimize your income or minimize your taxes, how you can use it for investment purposes, how you're able to split income with it or not split income with it, and then does it make sense to use RRSPs, TFSAs? Are there any other options we have for long-term planning? So we'll get into all of that.
Fantastic.
All right. So we talked about the firm. We're helping companies, businesses that are either in Canada or have expanded into Canada from various jurisdictions, whether U.S. or Europe or the Middle East. And it could be revenue generating companies or startups who are funded or VC backed, bootstrapped. And our focus, like you said, is streamlining the accounting departments, giving business owners more time, adapting and implementing the newest technology, and just creating an ecosystem for entrepreneurs, which I think Amna is doing as well. So that's what we love, the energy, and that's what we're all about. At a really high level, I think most of us understand what a corporation is, but it's an entity that is its own person, essentially, right? It can enter into contracts, own property, and it's separate and distinct from its owner. So the shareholders are not the corporation. They have some additional levels of protection than, let's say, an individual operating as its own entity. Where the individual is the entity, where corporation is its own person, by law at least. And because of that, it has to file its own tax return. It has its own systems that we have to go by. Now, why do we incorporate? We incorporate for a few reasons. One is tax deferral and income splitting. The more money we can keep in the corporation, the longer, the bigger pool we have to invest. So that's super important. Access to capital gains deductions in Canada, at least, and a lower small business tax rate. So in Canada, the tax rate on your first $500,000 of profit is, in Ontario at least, is 12.2%. In other provinces, it could be lower. And the capital gains deduction is really important. So if you're selling your shares of the corporation, you're allowed, or you get the option to pay zero tax on almost $1 million now. It's almost $1 million, about $970,000 of proceeds on the sale of your shares if it qualifies as a small business corporation. And then there's continued existence even after business activities cease. So let's say you have your business for a number of years, you stop that business, but there's cash that is retained in the corporation, you haven't pulled it out, you can still use that cash to invest and to grow your wealth. So there's a lot of benefits of having a corporation in Canada. Drawbacks, if there's losses in a corporation, it can be trapped. So we don't necessarily have the ability to use them, although there is allowable business investment losses in Canada, where if we've put money into a corporation and the corporation has stopped operations, gone bankrupt for whatever reason, we can use a part of that or half of those losses against our personal income in a given year. Issue number 2 is it is an additional or a lot more complex than a sole pro, and there's annual maintenance costs. So you don't necessarily need a corporation in every instance. You want to assess that on its own. And then not capital gains deduction is not available for everyone. So we just got to make sure we assess that. All right, tax deferral. Now, when we're talking about income splitting, income strategies, it's really important to understand, why do we have the corporation? And a lot of small business owners may not know this or understand this, but if you take out everything from your corporation every year, there's really no reason for you to have that corporation, like in my opinion, because the major benefit is really tax deferral, right? And when we're looking, I'll take you through a quick example here. So if you have a business owner who has income of, let's say, $500K of profit in their corp, and they have $150K that they need for their personal living expenses, an unincorporated business owner would pay about $232,000 of tax. So this is Ontario. I know you're out west, so it's a little bit less.
Yeah.
So,
I think it's 10%.
Sorry?
It's 10% in Alberta.
Yeah. So we're looking at it from a combined federal and provincial perspective here. So there'll be a little bit of fluctuation depending on which province you're in, but for this illustrative example, we'll use Ontario. So about $232,000 of tax only, right? That you're going to pay on $500K of profit. So if you're using $150K for your living expenses, all you have left to invest is $118,000. All right. So you made $500K and you're like, shoot, I only have $118 left to invest, and that really limits your potential for wealth building and for growth, and creating the nest egg that you're going to use for your family and to really take that leap of being financially free. So if you compare this, to an incorporated business owner, let's say they take out a salary of 250K from their corp, they're going to pay corporate tax on that profit of about 30,000. And in the corporation, they'll have available capital available to invest of 220,000. So almost 102,000 more, give or take some pennies and dollars here and there. So it's significant, right? So if each year, if we can save 100,000 in taxes, over 10 years, that's $1 million extra to invest. And if you look at the time value of money, right? If you look at, compounding returns, we're talking about really significant amounts here.
Yeah. So in this example, the annual business income is 500K, right? When you're saying annual business income, you're talking about, this is not the revenue line for small business owners that are tuning in. This is not the revenue line. This is revenue minus expenses is what's the income left over, correct?
Yeah, so it's our net profit.
Taxable income. Yeah, so it's our net profit before that you have to pay taxes on. And then out of that, so you are pulling out as a business owner $150,000 for your personal, like basically you're paying yourself a salary, right?
Yeah. That 150 is to cover, let's say, your living expenses, your mortgage, your trips to Walmart and Amazon expenses, everything else that's not covered in the corp.
Yeah. Okay. Perfect. So then you are paying yourself the $150,000 in personal salary, and then what's remaining is, and if you didn't do that, you would have to pay $232,000 in taxes. Correct?
Yeah. So part one is the unincorporated business owner. So
unincorporated. Okay. Sounds good. Okay. I understand that. Okay. Perfect.
Yeah. So if you're not incorporated, you're going to pay $232,000 in tax. After your personal living expenses, you'll have 118 left to invest.
Yeah.
Right. So that's scenario one. Scenario two is someone's incorporated. They take out a salary of their corp. So if you take out 250K from the corp, after you pay your personal taxes, you'll have 150 left for your personal living expenses. You'll pay 30K of corporate tax in the corporation, even after you take out your personal salary and your corporate tax. You'll have 220,000 left to invest in the corporation.
Okay. I do have a comment coming in, is like, but are you paying yourself 250K, not 150K? It's a bit confusing. So let's clarify this. In the incorporated business owner scenario, you are paying yourself a salary of 250. So then your corporate tax goes down to 300K. And then on personal salary of 250K, you're paying a tax, correct?
Yeah. So let's back up a little bit. So in the first example, as the unincorporated business owner, you're receiving all this money personally through your business. Because it's not incorporated, you're not paying yourself a salary, right? It's just money that you're using from your business so you'll need 150,000 for your living expenses. Now, as an unincorporated business owner, on your total profits, if you made $500,000 of profit, you're going to pay $232,000 of tax, which means you have left over $268,000. See, I'm good at math. That quick, right? 268,000. I was scared for a second. I was like, oh, I better not mess this up. So 68,000 left for your personal expenses and to invest. Now we take out the 150 from that 268 because that's what we need to pay for our living expenses. And what do we have left over? What are our savings? What do we have left to invest? That's where we get our 118 from, 118,000.
Okay, perfect.
Okay, so that's if you're not incorporated, you have a sole pro, you have a decent amount of income, you do well, you're building up the business and you're doing well, right? They're starting to earn enough where you can save as well.
Yeah.
And the second option is same business, but it's just under the umbrella of a corporation. So they're earning a decent amount of profit. They obviously have a second layer of tax when we take money out of the company. And that's where the personal salary comes into place. So on the personal salary, we're going to take that out. We're going to pay personal tax of about 100K on that. And then we'll have 150 left for our personal expenses. Now in the corporation, we have our profit still. So we had 500. The salary counts as an expense in the corporation.
Yeah.
So we have 500 minus 250. We have 250 that we have to pay corporate tax on. That's where the 30,000 comes in. That's the corporate tax that we have left to pay. So even after paying the corporate tax, we still have 220,000 left in the corporation that we can now go and invest. So 100,000 more a year over 10 years, an extra $1 million. Over 20 years, an extra $2 million, right? So we're talking about
Yeah.
substantial amounts that we can now use to invest.
That's like, this is genius math right there, right? Atilia, does that clarify your confusion? And if you still have questions, we're happy to dive further into this in the Q&A portion of the presentation as well.
Awesome. Yeah, so I'll go a little bit further on this, and there's a few other topics we want to cover, so I won't spend too much more time. But a lot of people sometimes mention or discuss, there's double taxation if you're taking out salary or dividends, and it's a myth, it's a misconception, because the tax system is based on this concept of integration. So whether you earn that money here personally or through a corporation, it should end up being relatively the same tax rate.
Yeah.
The only difference as a corporation is tax deferral. So if we can keep more of the money we're earning now in the corporation, we can grow it quicker. We have a bigger nest egg, and we can then build our wealth quicker. So that's the difference. So your first layer of tax is always your corporate tax on your profits. Your second layer of tax is when you take that money out of the corporation, whether it's a salary or a dividend. If you can, optimize for those factors, optimize for timing, then you're going to have more money to build your nest egg with to grow your wealth.
Yeah.
Cool. Now I know you talked about sort of in the previous session tax deductions and that, so I won't go too far into tax deductions if you don't want me to. But generally the rule is, or expense deductions, any expense incurred with the intent of helping me do my job or earning more profit is allowed unless it's specifically prohibited in the Income Tax Act. There's not many things that are specifically prohibited except golf fees, memberships, clothing, personal items, personal groceries. So we have a lot of flexibility, and now, so we have one part. We have our corporate profits. All the money comes into the corporation. That's great. Now, what do you do for your living expenses? You have to pay for your, let's say, your mortgage or your rent. You have children. You got to pay for their expenses. What do you do for all that? So your options to withdraw money for the corporation, what are there? There's a few options. One is a salary, which is an expense in the corporation. So we have a withholding each month on that. Dividends, which are profits from a corporation. So that's after tax, after corporate tax is paid, profits available for distribution, so all the shareholders. Reimbursements of personal expenses paid. So there might be some expenses that you're incurring personally, but are actually also those expenses are, or whatever you're spending money on is used for the corporation too. For example, if you have a home office, you could be getting reimbursed for the corporation for part of those expenses. If you are using a personal vehicle for business purposes, you could either take out a kilometer reimbursement for those expenses, or your cell phone, your internet. So there's a lot of expenses that we may be paying personally that should be paid by the corporation or could be, but for whatever reason they are personal. There's a portion that's personal, a portion that's business. So you want to make sure you're maximizing all those reimbursements from the corporation, because that's all tax free.
Yeah.
It really reduces like your personal annual living expenses, and the more you can deduct in the corporation, the better position you're going to be in.
And Shine, so I want to kind of mention this. So how you withdraw the salary or income to yourself doesn't have an impact of the reimbursement of expenses that you paid personally. So even if you were, like, say, a salaried employee, and you had like work from home expenses, or you were using your cell phone part-time or for corporation, you can still get reimbursement, or you can still claim those expenses in your taxes.
Yeah. So, for employees, even if you're a shareholder and an employee, or if you're just working at a company, you have all these opportunities. So if you're an employee, you can get your employer to reimburse you some expenses, but if they don't, there's a form, T2200, I believe, the Statement of Employment
Yeah.
Declarations, where your employer tells you what you are allowed to deduct because you're using those expenses in for your employment purposes, and you can deduct that on your tax return. But for people with corporations, yeah, even if you paid it personally, you can still push it to the corporation, and the corporation owes you that money, even if it wasn't paid to the corp.
Fantastic. Okay, let's talk about the magic here: salary versus dividends, or however, whatever. Yeah, see, okay, no, these are
Yeah.
common deductions, so we're right
Well, we
there.
can do. I know you guys did this last week, so I'm not going to go too much in
Yeah,
detail. But yeah, like basically anything that is incurred in the business on behalf of the company that was required to earn that income, or to build out an asset, or to build your IP, right? So there's no limitations other than golf dues. It could be travel costs, auto expenses,
yeah,
software, your staff, subcontractors, rent of physical space, professional fees, advertising, meals. Like I want, especially for a lot of professionals, we find that they're always looking for more expenses. So understanding what expenses you can deduct is really important. And we don't want people that ever hesitate to push expenses through. Is make sure that you have the documentation, you can support why you use that or how it relates to the business, and then just check with your accountants, check with your teams to make sure that it makes sense. But don't say no for the CRA, right? Like let them say no. Make sure that you're maximizing what you can do. All right. So now getting into some of the tax savings, and talking about how do we take out funds from our corp. So we have our salaries, obviously, which are expense of the corporation. It's fully deductible in the corp. You got to pay your source deductions. Make sure you're paying monthly, because the penalties on not paying your source deductions, your CPP, are quite high, and it allows you to build up your RSP room. So that's one of the benefits of doing a salary over dividends. Um, some people say, hey, I don't want to pay CPP because I think that the Canadian pension plan is not going to exist 20 years or 30 years from now. All fun arguments, but none of us
let's
really
not
know.
let's not spread rumors.
I know, I'm just telling you what I hear. I'm telling you what I hear.
I know.
So we actually promote taking a salary so you can build CPP,
Yeah,
because I think it's really important. It's a type of forced savings,
yeah,
and a safety net for individuals. So I really do promote people taking a salary, even up to, like, let's say the max RSP contribution building room, which is prorated, or which builds each year based on inflation and what CRA allows. And then, if you're going to take dividends, it's a great option as well, because it takes into consideration some of the tax that you've already paid in the corporation,
yeah,
and you get a tax credit for that personally, so there's no double taxation. And there's eligible and non-eligible dividends, meaning if your profits over 500,000, you in your corporation, you pay about 25-26% corporate tax rate.
yeah.
So when you're paying out a dividend, eligible dividends are dividends where you pay the higher rate of tax in the corporation. So you get a little bit less personal tax rate.
Okay.
So you can have a mix of salary and dividends. You don't have to do just one or the other. That's really important. People, need to understand that. And then you can also keep the money in the corporation. You don't have to take it out. You don't have to pay all the personal tax on the funds that you've earned. And what do you do now when you have excess money in the corporation? That's an important question. Oh,
So
actually,
before
before we
you
get into
jump
that,
into this, before you jump into the more advanced concepts, let's go back a little bit.
okay.
First, there's a question from Attila that says, what about paying for a course to obtain a designation, such as Advanced Scrum Master, that you will be able to use in your profession? I assume that's deductible, correct?
Yeah, 100%. So anything that's used to
Earn
earn income
income.
now or
Yeah,
in the future, right? So if you're building up your skill sets, it's training, it's development, it's software, it's access to a platform where you're going to learn. Like, all of that is to help you build up your skill sets. So I think that, again, all good questions, and we don't ever want to limit what we're going to push to the corporation. If it's helping us grow, if it's helping us learn, if it's helping the business grow or build IP, or really expand our offerings, there's no limit to our expenses. Even if, like, in Canada, like, I'm not going to get into this, but a really amazing way maximize our assets in the corporation is R&D tax credits. So if
Yeah.
anyone is doing SHRED, or sorry, scientific research and experimental development is the technical term for it in Canada,
Yeah.
which is just a really fancy way of saying a subset of all R&D because they don't want to pay for all R&D.
Yeah.
So if you're doing, let's say, any sort of new innovative development of software, of a process, of applied research, the tax credits in Canada are fantastic. It's some of the best in the world. So you could recover up to 60%, or roughly after the proxy and overhead, 60% of your staff's salaries related to R&D. You could recover almost up to 40% of like subcontractors who are involved in the R&D process. So it's really fantastic, and we push people to explore that. There's also tons of grants available for small business owners. I think I posted the other day one for founders of certain communities. So there's tons of opportunities available in Canada. There's tons of programs, and it's really important to look into these. And some of them are only eligible for corporations, so that's important to understand too. A really good reason to incorporate. And after a corporation's been around for, let's say, a year or two, so there's certain requirements required for those grant funding.
So the crux of it is that the two main mechanisms that are available to small business owners to pay themselves out of their corporation is a salary or dividends. And there are benefits to paying a salary, such as tax deductible. You're building that RRSP limit because it's a salary, it's an income. And then you are building that CPP, EI, like if you're paying into EI, stuff like that. And then there are dividends, and then they're taxed differently as well. So it definitely is worth having a conversation with Cheyenne here or his team, figuring out for your business and for your individual needs, which one would be best suited for you, right? It's not a one solution fit all. It's always based on, how much is the income? What is your financial plan? What is your wealth building plan? What does that all require to get that holistic advice, right? And that's where I'm saying that you are the advisors of the business, right? And that's where you spend a lot of time and bring a lot of value. And that's why there needs to be automated tools like Fuse Financial that free up your time, right? And the business owner's time, and give them like real time insights into their business, so they can spend time here into their future wealth building and planning. So there's some advanced tax planning concepts that you have put in there. I don't know if we're jumping right into them. Like, I haven't seen this presentation. Cheyenne has like kept it like a top secret from me. So
It's just good on it. So it's part of the fun I have here. So that's the
at the edge of my seat, Cheyenne.
yeah. Dory, I told you last week, where was I? Yeah, or the Law Society, where it was 300 corporate lawyers, and I was doing a similar presentation. And I like keeping everyone on the edge of the seats. It makes it more fun. With taxes, we have to keep it fun. Yeah.
Okay.
So I can do a little bit more. I'm not sure how much more time you have, but let's do a little bit longer, and then you can tell me if we're running out of time.
It seems like there's a lot of questions coming in on this. There's like another question from Imran Zafar. It's saying, what is the minimum dividend I can withdraw from my corporation in order to minimize tax, minimize paying tax, anything in my personal taxes?
Okay, awesome. See, I know Imran's just asking that because he knows it's a good question to point out. He's also an accountant, I know that. So if you have no other income personally, and you want to withdraw some funds from your corporation, in Ontario, you can draw approximately just about 40,000 or so of dividends a year personally. If you have no other personal income, that wouldn't result in any personal tax. So, this goes on to sort of, if people don't need a lot of cash from their corporation, let's say they have a lot of cash personally already, but they have a bunch of money stuck in their corporation or in the corporation that they've invested. Rather than not taking out money from your corporation, it still is good to pay a little bit each year if you have cash in your corporation. So you can take advantage of your personal tax rates at those lower tax brackets. So there's a lot of planning, a lot of sort of year-to-year review required from your accountants and from your team to make sure that you're optimized for all this. So it's really important to look at it every year and to think about it not only from a wealth building standpoint, but from a tax minimization standpoint as well.
Mm-hmm. Perfect.
Okay, so I know you brought me here to talk about income splitting. I'm finally got to it. All right. No, okay. So income splitting in Canada is actually pretty interesting. Everyone for a long time who had a corporation was paying their spouse, their children, their mom and dad, anyone who had low income in their families, where there were shareholders, and they were paying them dividends to sort of minimize personal taxes, right? CRA finally decided 4 or 5 years ago, maybe longer, that hey, we're losing a lot of tax money here because everyone's able to optimize who has a corporation and pay all these people who are not involved in the business. So we need to fix this and we need to close this. So now the question is, so those rules are, we refer to them as TOSI, tax and split income.
Yeah.
And what does it mean? So it means that if any family member is a shareholder of the corporation,
Yeah.
And they are not involved, generally we can't pay them dividends unless, again, it differs based on the type of company, but for most companies, they would have to be involved in the operations of the company continuously throughout the year for at least 20 hours a week, right? So that's sort of the baseline test that we use. But alternatively, let's say our kids or our spouse is involved in the business, we can still pay them a salary. We're not limited as long as it's, we're paying them at fair market value. We have a job description. There's a contract in place. So they don't have to be shareholders. They can still be working in the business and they can take salary out. So that's an important distinction to be aware of. And then, getting deeper into it, like, does your articles of incorporation allow for multiple share classes? Does it allow for dividends to be paid to one class of shares and not the other? So how about voting rights in your shares? So I'll stop there. But, there are more complex considerations as well that we need to be aware of.
Okay. Before you go and TOSI, basically.
Yeah. Well, okay. Let's talk about TOSI for a bit.
Okay, so small business owners have to consider all of these things. What is the best way? Like, what would be the advice that you would give them if they, they're new at this and they're trying to figure this out? What would be the starting point for them? What should it? What should they do to figure this out, or go about figuring this out?
Yeah, I think the most important thing for small business owners is to build out your professional teams, right? Who are strong and who are going to put the time into helping you understand what your options are and build out that strategy each year, right?
Okay.
So on this one, we look at, so when you're starting your business, you're making profit. Okay, how can I take money out of the corporation? Have I put all my expenses through the corp? All right. Are there any additional expenses I should be pushing through the corp? Now, how should I pay myself? Can I pay my wife? My wife or my husband helps me with the corporation. Can I pay them? Can my children work for me in the summer? Can I pay my mom or my dad helps me with, let's say, invoicing? Right. So all these things, like, you have to see what applies to you. Work with your professional team. Figure it out, see what options you have, and then the more opportunity you have to split income among the family, the better off you're going to be from a tax position.
Fantastic. Okay.
All right. So now we've talked about taking money out of the corporation benefits us. But what do we do with the money left in the corporation?
Okay.
So the good thing is we can invest it.
Yeah.
So it doesn't have to sit there. Some people are hesitant to do anything with that cash. They're not sure what the rules are, if there's any restrictions. So most corporations have the ability to invest excess funds. Let's say unless it's specifically prohibited by the board or in the articles of incorporation, the shareholders, let's say if it's a not-for-profit, there may be restrictions in terms of what type of investments they can buy. It might be just limited to GICs and whatnot. But for most companies, most private corporations, there's not a real limitation on what we can invest in, what type of assets. So that's important to remember. And you can invest your cash in your corporation, or you can set up a different entity, a different structure where you have, let's say, a holding company that owns the shares. You can own the shares personally. You can set up a holding company that's a sister company, and loan funds between the corps and invest in the holding company. So there's a lot of different options of how it's structured. I'm not going to get too deep into it, but you can buy regular portfolio investments, equities in public companies. You're allowed to buy rental properties. You can even use some of the excess cash to pay down corporate debt, so you're not paying interest at the current levels. On the flip side of that, you can borrow money to invest and write off that interest on those borrowed funds against any investment income. So there's a lot of options. Yeah. So I don't know if you have any specific questions on that, but we can get pretty deep into it.
Yeah, no, I don't have any question about this other than are there examples of what kind of, so for example, like thinking from a perspective of small business owner, and I asked that question last time as well, where you can, claim, you can under your business buy a building, right? So I'm thinking from the small business owner's perspective, one of the biggest purchases that any of us make in our lifetime is a house, right? So can you borrow under the company and buy a house, right? Is that something you can use the funds that are sitting in your corporation for use?
Yeah. So I'll talk about that. I just want to let you know that my team is offended that we said Tossie and not Tosi.
Oh, really?
Yeah, so they're very offended right now. So specifically, Arif, Christina, Hassan, Gafran. Yeah, I think it's very funny actually.
Oh, really? Okay. It's Tosi, not
So,
Tossi.
so it's Tosi, the future reference. Yeah, just so we're all on the same page here. Yeah, they're
Okay.
very critical of these people at my firm. Yeah, accountants, critical accountants. Yeah.
I think all
Yeah.
accountants, especially tax
Okay.
accountants,
Yeah. Specifically,
they're
Arif, he has a
especially
master's of
critical.
taxation. So,
Yeah,
yeah.
it has to be a special person to enjoy that.
he voluntarily spent a year or two of his life mastering in taxation through Waterloo. So yeah, him and our other yeah. So they're a
Yeah,
special bunch.
yeah.
Yeah.
We appreciate and love them to
Yeah,
bits
we love it.
because
We
they
love
help
it.
us save money.
Yeah. Yeah. They're the backbone of our firm. I can't make fun of them
Yeah.
too much. Yeah. Okay. So yeah, in terms of buying a house through a corp, this is a very touchy subject, right? So I would say for most people, it does not make sense and not to try to do so because there are benefits of owning it personally. The main benefit is that we are able to use our principal residence exemption, so there's no tax on any capital gains or any gains on that property when we sell it. There are ways to own a property through a corporation, but there's certain tests that have to be met. You have to pay fair market value to the company. There's other additional possible taxable benefits that would occur by owning it through a corp. So in most instances, it does not make sense. There are very few instances where it would, but you have to do that test annually. And the more capital or the more sort of down payment or equity you build up in that property, the less beneficial it becomes. So it's not necessarily the best thing to do.
Okay.
Yeah.
Perfect.
Yeah. So it like I've seen people recommend it, not at our firm because they would get in trouble for that. But it's not a good idea.
Yeah. What are some of the examples? So I think you have put some examples here. You can invest in shares, and that is the fourth session that we're going to have with wealth managers that manage company wealth as well as personal wealth. And that's going to happen in December, which is the last episode in this series. We just thought we would take a break for Christmas time and let small business owners focus on the holiday season. So they can invest in shares, they can invest in registered pension plans. What are some of the other examples? You talk about purchase a rental property, pay off debt. What are some of the other things that you have seen other small businesses do to create wealth and value for themselves?
Yeah, great question. I think that as long as it's not restricted by the corporation or the board, you can push through whatever you want. You can buy, let's say, any type of uh, Bitcoin or currency, any let's say basic bonds. You're able to do investments in partnerships or joint ventures. There's any types of real estate, not just, let's say, single family, multifamily, or funds that invest in multifamily. So you have a lot of opportunity. Anything, if there was an investment that you wanted to buy personally, you can probably put it through the corporation. Shouldn't be an issue. And like in the case of, let's say, for rental properties, for example, the reason we want to do that through a corporation rather than personally is it allows for another layer of creditor protection, and even secrecy in terms of who owns the property. If you don't want your
Yeah.
tenants to know your name, it allows you to have that shield in front of you that protects you from the public in general. But the important thing to remember is that there's still tax on the investment income in the corporation.
Yeah.
It is taxed at a higher rate than, let's say, your normal business income.
Okay.
Uh, yeah, so that's really important. And then once you surpass $50,000 of passive income or investment income in your corporation or in your group of companies, right? It does draw down or reduce our small business tax rate. So that 12.2% tax in Ontario uh, on the first 500K of profit, it reduces that. So that's really important to remember. So it's there are a lot of really good options by investing through a corporation, but I want to make sure everyone's aware of that as well. And other things that we have to consider, if the shareholders die of a corporation, then there's a deemed disposition on certain
Okay.
assets.
Yeah.
All assets are deemed to be sold for market value. So that's really important to
Okay.
remember. I'm not going to get into that too much, but another cool thing that you can do is if you want to donate, your
Yeah.
shares, or you want to donate money through a corporation versus donating it personally. A really interesting opportunity is being if you have, let's say, shares that you've built up a lot of gains on, right? And you're going to donate money anyways.
Yeah.
Rather than selling those shares and donating the cash, you can donate those shares directly to an organization, and then the benefit is that you don't have to pay capital gains tax on it, and you're able to get a deduction, or able to get that donation amount to the corporation. So, really interesting opportunities to deduct through a corp. If in a corporation, you can also sponsor organizations, whereas personally, if it's not a registered charity, you wouldn't get a donation receipt, so you have some flexibility there.
Okay.
And let's see. Okay, now we'll get into the RSP TFSA, or to retain
Yeah.
cash in a corporation. So I actually, on purpose, made this a little bit more higher level than let's just put money to RSP and get a deduction, right? So
Yeah.
everyone knows that. Or we put TFSAs with after-tax money,
Yeah.
and the investment income earned in the TFSA grows tax-free. Like, it's exciting. It's all basic. You have
Yeah.
Google and Wikipedia for that. You don't have. So when you have me, we get to talk about more high-level things. So
Yeah.
let's talk about. Okay, an RSP is great for individuals. It's great for business owners.
Yeah.
But there's even better options out there, and they're called IPPs,
Okay.
or PPPs, right? So individual pension plans. So IPP, what does it stand for? It stands for individual pension plans or personal pension plans. These are designed for small groups or single individuals who are involved in the corporation. We get an actuary to come in and figure out what amount they're allowed to contribute, and they work with the investment advisors. To be eligible, you have to be taking a salary from the corp, just like an RSP. So while you have, it's just like an RSP where you have this pension fund,
Yeah.
or assets that are for the pension of the individuals, and it grows tax free. Any investment losses can be reinvested. So the drawbacks of IPPs is that you have to get an actuary to come in and reevaluate the portfolio every few years. So there are some maintenance costs. But any funds in the actual accounts are protected from creditors. So that's really important.
Okay.
And then you can contribute more than, so that when it actually calculates it, your RSP is limited to 18% of your salary. So the IPP actually allows you for a little bit more deduction room and space. So that's the benefit. It's paid, it stays in the corporation. It's for the benefit of the employees or that small group of people or the owner, and it's actually larger than what you'll be able to contribute to your RSP. And the contributions to the IPP are fully tax deductible in the corp.
Yeah.
All right.
Okay.
All right.
So just wanted to sort of talk about here. I know that we can uh, I think a lot of the questions come around like everybody thinks like, okay, I made $50,000 as an income as a business owner, when you're just starting out, and then we start to maximize our RSP contribution, right? Oh, but I think there is a tipping point when that RSP contribution makes a lot of sense, and making any RSP contribution prior to that tipping point, you're just basically using up your room and not really getting a lot of benefit. Do you want to talk about that a little bit?
Yeah, you want to contribute to RSPs when the income you're earning is at the higher tax rates, right? You don't
Yeah.
necessarily want to use your RSP space when you're paying like 15 or 20% tax rates,
Yeah.
depending on your situation, right? If you're a business owner, you know that eventually you're going to start having to pay personal tax at high rates. That's when you want to use your RSP deduction. Or if you're an employee and you're making, above 100K, above 80, 90K, you want to make sure you use your RSP space first, then your TFSA, only if you know that these are long-term savings and you're not going to need those funds later on.
Yeah. Okay.
So that's an important distinction, because some people will use or put the money through a TFSA and they have no use for it. They know they're not going to need it later on. Really, you should be putting in your RSP if you know it's long-term savings, nest egg, you're not touching it,
Yes.
safety net. That's what RSP should be associated with.
Okay. Fantastic.
Now, yeah, now let's think about, okay, so people love TFSAs in Canada. They're good, but I would say that, you have to balance putting money into a TFSA versus saving money in your corp. There's a lot of analysis done on this online in terms of uh, paying personal tax, take the money out, put it into TFSA, and allowing tax-free growth in your TFSA. And both have benefits, and I think that long term it's really important to balance the two,
Yeah.
versus how much you have saved personally, what are your personal assets versus what you're leaving the corporation. You don't want to have all your money in the corporation and no assets personally and feel that you're living, like under the poverty line. You want to make sure that you feel
Yeah.
comfortable. So if it means you pay a little bit more tax, yeah, that's fine. You want to feel comfortable. You want to feel that, you have access to your capital. So balance. I'm not saying only keep money in the corporation. I'm saying balance and have a strong team, have the right tools, have the information available to you so you
Yeah.
can go online, you can check your Fuse account, you can see where you're at, and you can make sure that you're making the right decisions. All right,
Okay.
I'm done. That's it for me.
Wow. 10 minutes to go, right?
Yeah, there you go.
Yeah.
So
Are there
yeah,
any questions? I think we covered a lot of the questions as we kind of went through, but happy to take on questions further into this. If you go back to your last slide, I just had like a little question on this. Yeah.
yeah,
So, this basically goes back to, this is outside of the IPP. You can still do other investments, right? Is what you're saying, and you're
yeah,
saying
yeah,
that there's benefit to um, sort of splitting your income between TFSA and corporate saving because of the tax benefit, and also it can bring you like other benefits of like reducing um, your income, like because you can like withdraw money through dividends, which are sort of um, no, dividends are taxed at a higher rate, aren't they? No, they're taxed at a lower rate than the personal income.
yeah. So because you pay corporate tax, when you withdraw the dividends personally, there would be a little bit. The tax rate would be a little bit lower than it. Let's say if you took it all out as salary.
Yeah. Okay. Okay. That's great. I just want to let the folks know as well that we are going to be putting this together into a tax guide. So a lot of the information that Cheyenne shared here will become available for you to download on our website, and Cheyenne's website and on LinkedIn and stuff like that. So you can benefit from this. And also, this session is recorded, so you would be able to watch that afterwards as well. And I would encourage you to reach out to Cheyenne's team, and their contact information. Like, you can connect with him on LinkedIn. You can also connect with me on LinkedIn. If you have any further questions, we are happy to answer, and he's happy to answer and guide your business through the wealth creation process.
Likewise, and I did invite a lot of accountants today because I want everyone to be aware of Fuse in the platform that's being built. Because right now, we see other options, but they're not as comprehensive and they're not built as well. So I think it's really important for people to understand what your options are, and how the new cloud apps on the accounting and bookkeeping side, how they're fully integrated. So Omni's done a great job with their team of really, understanding what business owners need and building something for that, rather than, just building something that they think business owners could use. So she really spent a lot of time understanding what business owners need and built the platform for that. So kudos to you, kudos to the whole team. You guys have done a great job, and I think everyone should reach out to Omnet and really get a demo of the platform, because it's such a good tool. And it's just I think everyone needs to be aware of what options they have for their clients.
Yeah, for sure. So I thought maybe I'll just take the 5 minutes here and quickly show you, instead of telling, like we've been talking about it,
Awesome.
kind of like teasing you, keeping you at the edge of your seat. So this is what Fuse Financial is. And as Cheyenne mentioned, what we have done here is that we have brought together a host of tools that sort of live in their own little world, and brought them together for the benefit of the small business owner, so they can manage their banking, their payments, and their financial tools in one platform. So what you see here is sort of our banking suite, where you have wallets and accounts in which you can separate your different expenses. Our banking functionalities are way better than what you would see uh, or get from your banking platform. So you can easily, like, we're making the payments easier for small business owners to access. So you can send bank transfers, e-transfers, transfer money between your external accounts and internal accounts. And you can send invoices and collect them in less than 2 minutes. And all of this platform is fully integrated into the accounting platform they're using. You can also manage your expenses very differently than how you're managing them today. You can issue yourself cards, your employees' physical and virtual cards. You can put limits on them. You can put controls such as requiring receipt submission. So if transactions or certain number of transactions are missing attachments or receipts, the card automatically pauses, and then unpauses when those receipts get attached. You can also access recurring payments. So I know that a lot of the accountants don't want to deal with, and shouldn't have to deal with, and even the small business owners shouldn't have to deal with collecting the money, right? Because you have limited amount of time, you want to spend it on what creates value for your clients. So we basically have automated payment available in the platform. The payment options that go out to the clients are credit cards, bank transfers, e-transfers. So you can collect your invoices, your recurring payments using these three options in a very affordable way. So a lot of the apps, such as QuickBooks, is charging 2.9% plus 30 cents per transaction. Wave is charging 3.9% plus 60 cents per transaction for credit card payments. We are charging about 2% plus 10 cents per transaction. So it is like, I didn't want to not give the option of using credit card. What I wanted to do was instead make it very affordable for you to collect payments using credit cards. You can have your whole company and your employees on the platform. So you can add them as employees. You can add them as admin account holders onto the platform, and through that they get dedicated function. What's coming next is bill payments. So through the platform, you would be able to make CRA payments. You can pay your Rogers bill. You can also pay your rent. You can pay vendor, your subcontractors, all in one platform. And all of the bookkeeping and accounting piece, the reconciliation piece, is automated. So it is automated for the accounting. So let me share the tab. So for the platforms such as QuickBooks, Xero, FreshBooks, Wave, Sage, um, um, basically, which covers all of the small business owners in Canada. So yeah, thank you so much for tuning in, and thank you so much, Cheyenne, for talking about the platform and sort of giving me the opportunity to show it quickly in 5 minutes to people that are tuning in today. And we are almost at 1 hour, and so I don't want to take more of the time. We're all small business owners. We're all busy. Thank you for sharing such valuable knowledge that you have gathered over 15 years of helping small business owners and geeking out on taxes. And
When I was 15, so like 25 years.
oh, okay, sorry. Sorry, when you were 15.
Don't killing me on that. That's
Yeah, okay,
okay.
okay. I wasn't going to disclose your age. I wasn't going to
It's
call you
weird. It's weird. It's weird how long I've been doing taxes. I understand. Yeah.
out. Well, that's what passion is all about, right?
It's
Like
true.
that's
It's
what
true.
gets us and other small business owners out of bed and ready to seize the day.
Exactly.
Well, thank you so
I
much,
appreciate
Diane.
having me. Yeah.
Yeah. Have a good day. Bye.
All right, bye. See you, everyone.